Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. It promises to be a day which will be packed with action and maybe some red on the screen. I'm Neeraj Shah, you're watching Indian Open. Let's go straight to the headlines. The Turkish turmoil sparks a wider concern over potential market contagion, taking Asian markets lower. The SGX Nifty hints at a lower opening for the Indian markets. Saudi Arabian sovereign fund may be looking to increase its holding in Tesla as Elon Musk looks to take it private. HDFC Bank's deputy managing director and founding member Paresh Suthankar resigns from the bank. And higher realizations are likely to offset rising costs for Tata Steel in the first quarter. The IIP is an interesting mix as well. The data came out post-market hours and it showed a robust growth in the month. Let's wait and watch if that has an impact or not. Doubt that it will, because if we just look at how the trade setup is looking like, we're set for a weak start and a fairly weak start in the session today. Now let's look at what's happening across the world. I think worldwide there is only one piece of news that exists right now, and that is what's happening to Turkey, and if at all it has the potential to have a contagion impact. Look at what's happened in the global markets on Friday and spreading over to the world markets and the Asian markets in early trade today. The financial crisis in Turkey has spooked the global markets, and we've seen that happening in Friday's session as well. It's the biggest currency shock for the Turkish lira since 2001. I mean, that tells you about how strong the knock was for the lira. Over 17 years, we haven't seen this kind of a move in the lira. And there is unease over whether this plunge in the Turkish lira and the economic crisis out there, if I can use the term crisis, can fuel a contagion impact. That is the worry, and we'll be talking about that with experts in just moments from now. But I think that's essentially the worry. Now keep in mind, all through this year of 2018, every time there has been a knock, and a good one at that, bulls have been able to weather that. There has been buying that has come in, money on the sidelines. We've been able to weather all of that. Have we seen something like this? Or is this just one of the other factors that will come and go away? I think that's the question. Could this time be different? Could this be the tipping point for the correction that we've been waiting for? I think that's the question on top of everybody's mind, and we'll try and probably get some answers to that later on. US markets didn't do that well in Friday's session. Europe had taken a bigger knock in Friday's trade, and Asia is not starting off on a good note today. Nikkei down about 1.6%, Shanghai down about 1%, Hang Seng 1.5%. The SGX points towards a 0.5% downtick, but that may not be conclusive. So we'll start off in the red for sure. Whether or not we fall further remains to be seen. And frankly, I mean, multiple issues for Turkey notwithstanding, because their corporations are saddled with high debt. Their inflation is on a run. I think it's at some 13, 14-year highs for Turkey. There's a large current account deficit that the country has, amongst the highest amongst the emerging market pack as well. So there are a lot of problems out there. Can this disrupt the party? For the other markets remains to be seen. We ourselves took a bit of a plunge in Friday's session itself. If you just look at what the derivative positions have indicated in Friday's trade, the Nifty OI may have been slightly higher, but the Bank Nifty, there's a fair bit of unwinding that came in, 5.5% lower, the OI out there, and that Nifty Bank corrected quite a bit, post SBI numbers maybe, but corrected quite a bit. And while the call and the put levels still indicate this 11,000 to 11,500 range, and don't expect there to be anything different in a day, but this may well change over the course of the next few days. I'll be very, very interested in seeing what the writers have to do over the course of the next 3 or 4 sessions. It's a truncated week, mind you, but very, very interesting to see what the call writers do over the course of the next 3 or 4 sessions. That's something that you should watch out for. However, while we'll start off lower, what are the stocks that you should monitor in the session today? Amongst other things that will weigh in on the markets due to individual news is HDFC Bank. I don't need to say anything else but for the fact that Paresh Suthankar has resigned. News came out post-market hours in Friday's session. The ADR is a bit of a giveaway. We will start off marginally lower. The Bank Nifty is not in a very happy space right now. Could weigh in further on this stock in the session today. There were some decent numbers, a clutch of them. I've chosen 3. There are a few more, but I thought Corporation Bank numbers quarter on quarter looked fairly impressive. Prabhat Dairy on a low base albeit, but the bottom line numbers look very impressive. Let's see if this reacts. And Sun TV marginally ahead of estimates as well. We have the management call lined up at 11 today, or 12:30 today as the case may be, but that's an interesting set of numbers to watch out for. And last but not the least, PVR and Inox. Now, both of them are in news because on Saturday, there was a release that came out, or maybe late Friday, the release that came out that the Supreme Court has stayed the order of a Jammu and Kashmir court allowing patrons to bring in outside food. Now, will people want to extrapolate this to the rest of the country? Remains to be seen. And for PVR in particular, there's a specific piece of news. The company is going to acquire SPI Cinemas in a deal to expand presence in South India. It's a large one. The management will do a con call today and then do a chat with us at about 12:30 today. So PVR individually is in news because of this reason, but there is some bit of positive news from a Supreme Court verdict that has come out for a specific region, yes, but maybe, just maybe, the market would believe that this could get extrapolated to all cases that will be there, Maharashtra and a few others as well. Let's wait and watch how it pans out. So all of that will be in focus today. However, what do we have today on the show? On First Word and a bit later on, we got a very special voice on the entire Turkish standoff and its impact on other emerging economies. JPMorgan Chase Managing Director James Glassman would be joining us in just moments from now. Back home, the Sensex may have been one of the best performers in Asia, but it commands a sizable premium now. Devina puts this into perspective. Somit then Johnson to tell us why a closer look at the OMC earnings will show cracks in the armor. And Shraddha explains why the pain may finally be ebbing for some of the largest public sector lenders in the country. And as Paresh Suthankar steps aside from HDFC Bank, is the lender strong enough to weather this high-profile exit? I'll try and weigh in on that for a bit. But can't not start off with arguably the most important piece of news around the world. The Turkish lira plunges to a record low in biggest shock since 2001. Erdogan's growth at all costs agenda and sanctions from the US is pushing the country towards what a lot of people believe is a financial crisis. Other emerging markets too have taken a hit as the contagion fears spook investors. To talk about the situation in Turkey and its effect on other markets is James Glassman, Managing Director at JPMorgan Chase. James, good evening to you, and thank you so much for joining in this late in the evening.
Yeah. Good morning.
The simple question is, one, could this have a contagion impact, and is it possible to predict that at this stage?
It's probably too early to predict that, but I think it's pretty unlikely because the heart of the crisis is really born in problems in Turkey. The problem is they're running very high inflation rates, and the indebtedness of the private sector has doubled over the last decade, so they're really in a bind. Higher interest rates aren't going to be the only solution here. So I think because the crisis is largely a result of domestic problems in Turkey, it's not likely to become a spread to a broader contagion.
Interesting. If this worsens, you still believe, James, that this will keep it restricted itself to Turkey and maybe a couple of other markets which would have trade and not necessarily spread across Europe or emerging markets? Forget this stage, if this were to worsen further.
I think that's probably right. I mean, there are other countries that have similar situations that the market sort of worries about, but I think because the financing problems of Turkey they depend so much on external financing, you can understand why this is becoming a currency crisis. But I think because the broad economy of the European region, the North American region is pretty strong, I think this is not likely to spread around the world. I think this is really pretty much confined to problems that have been festering really for a while in Turkey.
James, I think what adds fuel to fire is the standoff between the US and Turkey. And if Erdogan's speeches on Sunday are an indication he's not backing off, or at least not showing signs of backing off, do you think part of the tension would get diffused if over the next 7 days we see some bit of resolution happening between Turkey and the US?
You know, we don't think the tension between the U.S. and Turkey is that much of a problem. And so for that reason, I think if there were some backing off, I doubt that we would see a resolution to the crisis. I mean, it might be some modest help, but I think the real problem is the underlying domestic situation is really creating a lot of the stress. So I have a feeling it's an easy target to focus on the tensions between the U.S. and Turkey, but I think that's really not the heart of the matter.
What is then?
I think the heart of the matter is really, Turkey is running very high inflation rates. The economy is quite heated.
Okay.
And the private sector is very dependent on the indebtedness of the private sector has really grown enormously over the last decade. And so Turkey is very dependent on the confidence of outside investors, and that's creating problems when outside investors have issues.
I get your point. James, I have one final question, and that's not really only related to Turkey, but markets at large. Indian markets have rallied quite a bit. We've seen a bunch of other markets, the large ones that matter, save for China, trading in or around highs. A lot of articles, a lot of opinion out there about how the markets are waiting for one key reason to have a bit of a steep correction. Almost all shallow corrections have been bought into very effectively in 2018. What are we looking at for the rest of the year? Could Turkey or some of the other reasons or other events like this be a reason that the market is looking out for? Or are you sanguine on the prospects of markets by and large for the rest of 2018?
I think we'd have to be more centered around some kind of major trade dispute. Honestly, I think that a lot of the trade tensions between China and the U.S., the market seems to be ignoring it, and I think the reason is because they sense that there's a lot of negotiating going on here, and both sides have equal leverage. So I think it's got to be something more surrounding the developed economies or China and the U.S., and I don't think that's likely because I think the U.S. economy is in pretty good shape, growing rapidly, and the Chinese are doing a pretty good job managing their slowdown. So I think without a serious inflation, some kind of imbalance like an inflation threat, it's hard to believe that we're facing some major setback in the markets anytime soon. Okay,
my last question, James, as things stand, am I to assume that you are more bullish than bearish on market levels per se and market fundamentals for the rest of the year?
You know, I'm pretty neutral, I think, in the sense the markets have come a long way, and we're already very close to all-time highs, and we don't really know how this trade tension is going to be resolving. And I think until that clears the air, and it's hard to believe it is anytime soon, it's hard to be strongly one way or the other. I don't see any reason to be negative on the markets, but I think the upside is somewhat limited now that we are at these high levels.
James, really appreciate you taking the time out and speaking to us at Bloomberg Quint India. Thanks so much.
Okay. Bye-bye.
Well, that's the view from the MD of JPM. Chase doesn't believe that even if the Turkey crisis were to worsen, it will have a contagion impact. The markets, or Asian markets by and large, may be soft today, but that may be short-lived if James Glassman is to be believed. Well, if you just look at Asian markets in isolation, though, the S&P Sensex is one of the best performers amongst the Asian peers. But outperformance often comes at a price, and in this case, a premium over others. Devina Menon is here to tell us by just how much and what could be the factors at play which have taken the Sensex to such a level. Devina, good morning. Interesting that the uptick that we've seen has led the valuations to arguably the highest amongst the Asian peers.
Well, it is, and if you see a complete divergence in terms of pricing performance as well as we've seen for the Asian emerging market basket. So while the Sensex year to date has actually performed really well, you know, more than 11% gains for the Sensex, so today you might see a few cuts. But for the rest of the pack, if you take Shanghai, you take Philippines, you take Indonesia, you take China, they've all seen heavy cuts coming across. In fact, if we could have, you know, the price performance year to date, you'll be able to see visually the difference and the dichotomy in terms of the pricing performance. The Sensex, they're right up on the graph. As you can see, 11.3% as of Friday's close, and the rest of the markets seem to be a little bit more subdued and tapered out. Obviously, now this comes at a price. Like you said, it's driven valuations high. Remember, you've been in the midst of the earnings season, so a good corporate earnings season has lent some more support that's come into the markets as well. But as you can see, right at the top of the chart there in terms of valuations for India, Sensex at 19.69 in terms of the 12-month forward PE estimates. Philippines at 17.04, Malaysia, Japan, Thailand, Taiwan at 13.95. The lowest there is South Korea at 8.48. So yes, it is expensive, but remember, we are still doing this on the back of our own domestic flows. We're actually not too high on the kind of foreign investment that's been coming in, though I must say that the last few days have been good. You've been seeing foreign money coming in, but that's not been the trend for for the year. So year to date, we've been doing this on the back of heavy domestic investment that's been coming in. Just looking at the overall participation of DIIs, almost $10 billion year to date is what they've done it. In terms of other drivers, well, we're not at the epicenter of the trade wars, though collateral damage, as we heard from our guests as well, could be witnessed for India as well as a whole. But overall, we're strong in terms of our own ability to pick up from there. In fact, it could be an opportunity if not for the trade wars for India. Aside from that, we've got the earnings momentum. So from this year onwards, FY18 to FY20 CAGR, if you see for the EPS earnings, is 23%. So that's something that you can draw hard from, aside from what you saw from FY8 to FY18, which was just a 5% CAGR in terms of the earnings EPS. More opinion coming in, positive opinion from experts as well. We managed to catch up with Nilesh of Envision and Vikas Khemani. Both of them believe that we're really well placed in terms to optimize the rally going forward as well. So, we've got capital gains coming. We've got overall investment cycle picking up. Government is directed towards the right parameters like curbing inflation, pickup of investment cycle, tackling fiscal deficits. So all of these things weigh in better for India.
Oh, interesting. Thanks for that, Devina. Just a point on the flows as well. If you pull up the terminal function, it'll show you the point that Devina was trying to make, that inflows into India haven't been, or the outflows from India haven't been too steep compared to a lot of other markets. However, not enough flows, save for the last 15 days. Yeah. But the good part is that the domestic participants...
So if you see the month-to-date number there, about $211 million is what we've gained into equity, but the year-to-date number is still negative 200.
Yeah, but which is far cry from what some of the other markets have seen. Okay, great. Thanks for that, Devina. Thanks for putting that into perspective. Well, the Indian market's amongst the most expensive Asian markets as of date. What's led to this? Maybe a good earnings season, but let's dissect the earnings season on a couple of key sectors. Firstly, the oil marketing companies. Inventory gains coupled with the ability to pass on higher crude prices have helped oil marketing companies report a higher figure at an operational level in the first quarter. But it may not be wise to celebrate just yet, because a closer look at the core business will show cracks in the armor. Sumit Sarkar is here to put the numbers into perspective. Sumit, why are you saying cracks in the armor?
So I'll start off with the good part first. So if you see the standalone EBITDA of all the three oil marketing companies, now that has increased sequentially. For Indian Oil Corporation, it has increased by 14% compared to last quarter, while that for BPCL and HPCL, it has increased by 4% and 9% sequentially. But this was not on account of good core operational performance, but on the back of higher inventory gains. Now if you see the inventory gains for these oil marketing companies, Indian Oil Corporation's inventory gains jumped nearly 2.3 times to 7,866 crore rupees, while that of BPCL and HPCL increased 6 times and 12 times compared to last quarter. So it was mainly on the back of higher inventory gains. Now, due to some adverse rupee movement, there was also some foreign exchange losses that these oil marketing companies see. So if you remove this inventory gains and the foreign exchange losses, you will see the core operational performance. Now, if you see the core EBITDA of all the three oil marketing companies, that is after adjusting the inventory gains and foreign exchange losses, now it has declined for all the three oil marketing companies. Indian Oil Corporation's core EBITDA declined by 21%, while that of BPCL and HPCL, it has declined by 44% and 36% compared to last quarter. So this shows how weak the core operational performance was for all the three oil marketing companies. Now, refining and marketing is their core business. So if you see refining and marketing is the core business. So if you see their business on that front, HPCL and BPCL have seen the negative performance in their refining side. Now their refining EBITDA has turned negative. It is around 13 crore rupees for BPCL, and for HPCL it is negative 101 crore rupees. While for Indian Oil Corporation, it has declined by close to 21% compared to last quarter. Now on the marketing side, if you see, now on the marketing side, other than Indian Oil Corporation, for HPCL and BPCL, it has declined compared to last quarter. It has come down to 1600 crore rupees for BPCL and close to 605 crore rupees for HPCL. But for Indian Oil Corporation, it has increased sequentially to 2421 crore rupees. So that was on the core operational performance. For Indian Oil Corporation, it has remained good on the marketing side, but for other two oil marketing companies, that is HPCL and BPCL, it has remained weak. Okay. But the overall performance was weak for them.
Okay, and specifically for quarter 4, while you threw some light there, how are the marketing margins been? How are the other parameters looking like?
So far in Q2, if you see, the gross marketing margins earned by these oil marketing companies have remained largely stable. Now the gross marketing margin earned on sale of every liter of petrol and diesel, it has remained stable at 1.5 rupees rupees and 2 rupees per litre. So there is no much surprise here. On the refining side, if you see, the Singapore gross refining margin, that is the Asian benchmark, that has also remained stable so far in the second quarter. It has remained at $5.9 per barrel versus $6 per barrel reported in the last quarter. So there are no surprises on these two fronts. But there is a possibility that all the three oil marketing companies could report an inventory loss in this quarter, and that is because the crude is not only averaging lower in this quarter, but also we have seen some sharp movements in crude. But it's still too early to say because half of the Q2 is remaining. So we'll have to see how these things pan out for all the three oil marketing companies. But so far, if you see, the refining and marketing segment are still stable, and there's a possibility of an inventory loss. So we'll have to see how that works.
So is the street taking heart from this particular fact, or Sumit, are people worried about what will happen to these numbers since we are entering a busy election season?
So no, all the analysts are very bullish on all the three oil marketing companies. For Indian Oil Corporation, if you see, close to 80% of the analysts have a buy rating on the stock, and the return potential over the next 12 months, what the analysts are expecting, is close to 29%. For BPCL, 76% have a buy, and the return potential is 19%. Well, for HPCL, 71% have a buy rating, and the return potential over the next 12 months is 31%. So analysts seem to be bullish on all the three oil marketing companies.
Well, interesting. It showed in trade in Friday's session as well. Let's just see if that lasts or no. But Sumit, thanks for putting this into perspective. Well, that's all that you needed to know about how the performance of the oil marketing companies was in the quarter gone by. But another space that's been in the center of action and that's been under pressure is state-owned banks. Large defaults, insolvency proceedings, more stringent recognition norms. We all know the story, don't we? The question mark is there a light at the end of the tunnel? Shraddha Babala is standing by to give us that precise answer. Shraddha, is there light?
Okay, let's look at some data before we can actually answer that question and say if the first quarter was indeed a quarter of turnaround for PSU banks. And here we are talking about the larger PSU banks. So except for SBI, which reported a surprise net loss in the quarter, we did see a better than expected bottom line being reported by all these PSU banks. That could have had to do with huge recoveries from NCLT to NCLT cases, as well as tax write-backs for some of them. Because if you compare on a year-on-year basis, it does seem like the earnings growth remains elusive for these PSU banks. But having said that, the net loss, reporting a big net loss, at least seems like is done with for now. Now, even if you look at recoveries, and the first quarter was set to be a quarter of recoveries, and that was expected to be the silver lining. Did that happen for these banks? Yes, huge recoveries for all of these banks, which aided the bottom line performance for these banks. The question here really is if this sort of performance on recoveries can be replicated, because remember, we did have interest for the likes of Bhushan Steel and Electro Steel, which was much larger than what is believed to be for some of the assets in the NCLT2 list of accounts. And also bankers are expecting haircuts to be much larger for the NCLT2 accounts. So the question remains if FY19 will be a year of recoveries and resolution as well. So far, the belief was that FY18 was going to be a year of recognition and FY19 of recoveries. But now, after this quarter, it seems like recognition is not yet done, and recoveries and resolutions are two factors which will have an interplay on FY19 earnings for these banks. Even if you look at the gross NPA number for let's look at the slippages. So while recoveries have been sizable in the first quarter, even if you look at some of these slippages on a Q-on-Q basis, while there has been a sharp improvement for all these banks, the number for slippages, fresh slippages in this quarter is much larger than the recoveries number. So that is something that could remain a little pain point for some of these banks. Even if you look at the gross NPA numbers, we did see the gross NPA in absolute terms declining for most of these banks, just a 3% uptick in case of Union Bank. The question is, what is the impact of all of this on the capital ratios, because that is the most critical for some of these PSU banks. While we did see that the capital adequacy ratio, which is yellow, improve on a Q-on-Q basis for most banks, the CET1 still remains below regulatory requirement for PNB, as also for the likes of Union Bank of India, as well as BOI, are both very close to the regulatory requirement number. So the question again for this one is if the non-core asset sales and recoveries is going to be enough in terms of the capital requirements for these banks in FY19, or will they continue to remain dependent for government support when it comes to the capital? Another thing that I wanted to highlight was the dispensations that were used during the quarter. Except for SBI, most of these banks had huge MTM losses which they have chosen to defer. Why is that important? Because it will mean that they will have to make provisions for this in the future quarters, which means credit costs will remain elevated, and again that could have a bearing on the earnings. So based on all of this, can we really say that Q1 was a quarter where we did see turnaround? Probably not, because slippages have continued to remain high. Some of these banks have also highlighted newer areas. SBI highlighted a significant slippage in the agri sector. Canara Bank had some issues with their SME sector. So recognition cycle is still not over. SBI has a huge watch list that they could retire in this year. And that apart, there are non-core asset sales and recoveries. Neeraj, question is if that is enough to meet the capital requirements. Having said that, the worst seems to be over. I don't know if good times have started or not. Worst seems to be over in terms of asset quality, and banks are done with reporting those huge losses in all likelihood.
Yeah. The only question, Shraddha, is that almost everybody said that at some point of time the pain will ease. Sadly, we don't have a conclusive answer to that.
Yes, but at least it has started to ease for sure, and that's what the asset quality numbers show. Are we done with all the recognition? That remains to be seen, but seems like FY19, yes, could be that year finally, because on the other hand, while you have balanced recognition being done, recoveries have also started to come in.
Yeah, and then the other question is, let's see if they can even turn the clock around and start growing in a meaningful way, because eventually the markets will pay the premium for growth. Otherwise, you have the private banks doing what they're doing, or maybe the corporate facing banks doing this too.
Over the longer term, of course, that remains a question mark, because there's this factor of consolidation, and if banks are really going to be able to get back the market share that they've lost and are going to be able to compete with private banks. But at least in the near term, the valuations seem favorable, and if there is at any point a conclusion that yes, there is significant turnaround happening, the delta for these obviously will be higher.
Yeah, I mean, I don't know. I'd be surprised if it happens in a hurry, Shraddha, but let's wait and watch. But interesting, Shraddha Babala saying that it seems that the pain points are coming to an end. Whether or not it returns to growth remains to be seen. Fantastic piece, Shraddha. Thanks for putting that into perspective. I'll just take a moment to dwell on one more piece in the banking space before we wrap up first word, and that's the leadership change underway at HDFC Bank. Paresh Suthankar, Deputy Managing Director and a member of the founding team, has resigned. Now, let me just put this, for the benefit of viewers, let me put it into perspective. The tenure of Paresh Suthankar at HDFC Bank. He was appointed in March 2017 as Deputy Managing Director. So elevated, let me put it that way, elevated to Deputy Managing Director, who has been the face of almost all earnings from the time that I've looked at HDFC Bank seriously. He handles the credit and risk management, finance and the HR functions at the bank, and was seen by almost everybody as the natural successor to Managing Director Aditya Puri when he resigns. Having said that, he's quit. He's put in his papers on Friday. Now, you know, it could be a worry for a few people. I just tried to look at various perspectives to give us an indication of what some of the top leadership changes and some key personnel leaving HDFC Bank over the last 5 years has done to NII, to ROEs, other factors. The one factor that captures all of this is the price performance over the last 5 years. And if you just pull up that graph, that says it all. The yellow line, which is the top gainer over the last 5 years, is HDFC Bank. And if that is any indication, because HDFC Bank's price to book remains more or less constant, so the book needs to have grown at a pace which the market likes for the price to have performed the best amongst its private market banking peers. I could have added in IndusInd Bank there, but having said that, looking at the larger names, Axis, ICICI and HDFC, those are the three that I've compared. And it clearly shows that the last 5 years, multiple exits have not impacted HDFC Bank in a meaningful way. And in fact, that's what a couple of brokerages, I mean, we've put out two notes out here, and that's what largely the brokerage community seems to believe. That's what largely the fund management community, which spoke to me off record, had to say over the weekend as well. But I'm just giving out what brokerages have said. JPMorgan, for example, came out with a note saying that while the departure is unexpected, but they see no operational issues. They see a temporary stall in the stock's outperformance. But could it result in an underperformance? I don't think the note dwelled on that at all. Macquarie mentions that it's a system-driven bank, growth and asset quality is stable, and that they are confident that bank can manage this challenge well. And frankly, after Paresh Suthankar leaves, unless HDFC Bank shows the chinks in the armor, it would be too premature to believe that this will be a spanner in the wheels for HDFC Bank. Remember, Aditya Puri stays on board till 2020, so they have their managing director in and enough time for him to groom a natural successor, whether from outside or inside. So too premature to say this will have a big bearing on HDFC Bank's performance over the medium term. Short term, well, sentimentally, there could be a reaction or two in today's session. But that's all that we have on First Word today. Lots more lined up on Indian Open. We decode the June quarter earnings with Shilpa Naval Kumar of ICICI Securities. Talk more about what the business is looking like as well. And Shekhar Ramamurthy of United Breweries will join us first to talk about how their quarter has been like. But after this break, full tilt towards the day's trade.